Welcome, Multifamily Investor Nation. Welcome to our this month's webinar. I am so blessed to have Whit McCarthy on, our managing partner over Consistent Capital. But before we do that, I want you to go to the chat box and let us know where you're joining in from, because it's always so cool in these live webinars to see where everybody's joining in from. So also, that helps you find your chat box and your Q&A box so you can ask questions. Awesome. All right. Chicago, Illinois. Yes, I've got family in the area. Perfect. Is that LA or Louisiana? Help me out there, Chip.
With the
Me,
period, I'm assuming LA, California.
I'm assuming LA, but you never know, right? Atlanta, Georgia. Awesome. We got people
Love
from
it.
all over. This is amazing. All right. Well, guys, we do this monthly webinar to help you learn a skill that you can apply to your uh, operating business as a syndicator, as an operator. So this month, we're going to talk about how to build a debt strategy, especially in that smaller debt arena. Multifamily deal is about 5 to 50 units. And again, if you are just now joining, I am blessed to be joined by Whit McCarthy, our managing partner over Consistent Capital. Whit, welcome.
Thank you so much for having me. I appreciate it.
Well, awesome. Well, Whit, I know your background a little bit, but can you share with us your background and what Consistent Capital does to help operators close today's deals in today's
Sure.
environment?
Absolutely. So I've been in the lending world for the past 14 years. Was fortunate enough to find myself, I was in Los Angeles at the time, and I first jumped into the industry and found myself in the right place, right time inside of an environment in which we formed and started a company called Civic Financial Services. And that was a business that we built up over 11 years. And at the precipice, at the very end of it, we had originated over $10 billion of business purpose loans on residential and multifamily assets. A lot of that being bridge debt, fix and flip, value add opportunities, also long-term perm financing, mostly for residential properties. But it was a great business, and we ran that for as long as we could. We were acquired by a bank, Pacific Western Bank, out in California, and with Silicon Valley Bank and the whole regional bank run, that business got wound down. And that was it was unfortunate, but it provided me the opportunity to strike it out on my own. And I formed Consistent Capital with some partners here in Charleston, South Carolina. And we started off as a regionally focused lender, providing debt solutions to real estate investors. And that covers DSCR financing, it covers ground up construction financing, fix and flip, multifamily value add, multifamily bridge, as well as multifamily stabilized, up to a certain number of units. So yeah, we're in the business of providing debt solutions to real estate investors in the Southeast and beyond. Right now, we're currently covering about 32 states, most markets that are west or east of Colorado at this point.
Awesome. Well, and I live in Colorado, so that's kind of like the delineation line here. Well, why is small to mid multifamily such a strategic niche for Consistent Capital, and what makes the debt side of these deals so crucial to address right now?
We're operating in a pretty, like you said, niche space. I think it's there's a lot of appetite and desire for more, commercial outlets in the larger balanced commercial deals. But I think there's a really underserved marketplace in that 5 to 50 unit, that 5 million and less, total loan amount. I think that there's a really solid niche to be operating in to support investors that operate maybe just on a smaller scale, units wise, right? We work with a ton of investors that are very systematically purchasing these 5 to 50 unit buildings and aggregating those to having, portfolios that rival some of the large players, but they operate in just a smaller unit count on a per property basis. So, I think it's a nichier product. It doesn't necessarily get the full attention from the CRE markets. And so I think we have a really viable solution for real estate investors focused in that unit count for both bridge. We've got a really strong product to support value add and lease up opportunities in the 5 to 50 unit space. And then when it comes to permanent financing, we've got really competitive DSCR loans that is kind of a bleed over from the residential space, but a DSCR loan on a multifamily asset up to 10 units. So We've got a really strong offering there with just a product that makes more deals work than you can otherwise find in more, bank settings or CRE type settings.
Well, it sounds like you guys have a unique opportunity to solve a lot of problems for these multifamily investors in the specific niche area. Now, I do want to get into the product lines, but let's kick it off. Like, what are some of the common mistakes that you see operators and investors making on how they structure their financing in this kind of 5 to 50 unit niche area?
Yeah. I mean, I think at the end of the day, you just need to have a solid underwriting model and these 5 to 50 unit bridge or value add lease up opportunities, you have to be tracking and underwriting the future, right? And you have to have solid underwriting methodologies in place to track, where you're at today, but where you're going to take this because you have to be underwriting to the exit, right? This bridge is not permanent financing by any stretch of the imagination. You have to have an exit and you need to track the fundamentals to that. And so that comes to I think tracking the market fundamentals are number one, right? Because if all of a sudden you're, doing a value add opportunity in a project, putting it into a market where there's a ton of upcoming deliveries of new product, and you're going to have to have competing product in there, you're going to have to adjust your rents down to kind of be able to get the necessary renters in the door. It's just we've seen plenty of investors that I think have not properly underwritten the market themselves to what is actually coming online in the future that could negatively affect their position. Besides that, I think, like I said, it's just not properly tracking to the exit, understanding kind of what the necessary DSCR thresholds are going to be for the takeout. And in that, I would say million, 2 million plus range on the loan amount, there are, Fannie Freddie products that I think are really strong, but you need to make sure you're underwriting to what that takeout is on the back end. And I think not overestimating a lot of the rents and what's going to be achievable on the back end upon stabilization. And then lastly, I think in any sort of value add opportunity, it's always the underestimation of the rehab, underestimation of what it's going to cost with, increased supply and material costs and labor. We see people constantly just not having enough budgeted to necessarily work through those budgets. And then all of a sudden, tons of change orders later, they're all out of whack. And as a lender on the front end, we're financing acquisition, we're financing the rehab, right? And we have a necessary amount set back as that rehab budget that's dispersed over draws. And I think when someone does underestimate and they don't properly think about the contingency associated with that, that's where you see people just get in a position of not being able to fully, take that product all the way through and get into that stabilized position based off of a lack of liquidity.
Now, there's a lot of mechanics that you threw out there, and as somebody who has scaled a single family rental portfolio of 40 units, largely in fix and flip,
Mhm.
value add type strategy, done the value add multifamily, active investing as well. Okay, so underwriting the deal, looking at the market, making sure you're looking at the carry out loan on the backside. If those are like kind of the big moving issues that get multifamily investors in trouble, when they come to you, what should it look like for them to be in a good, strong position? You know that that operator has thought through all these problems to begin with.
Yeah, I mean, the pro forma is going to tell us a lot, right, as to what they see the stabilized values to be for rents and everything on the backside. And so we're gonna stress test that. And frankly, when we first get that pro forma, we're going to try to figure out ways to kill that deal up front. So frankly, that investor doesn't waste their time, nor do we, because we want to make sure we're not getting into a deal, working through appraisals that are super expensive, as we all know, and all of a sudden coming back with just way below their pro forma rents inside of that appraisal report. So I think we try to stress test it as much as we can on the front end. And then those performers are just super important for us to dig in on. And ultimately, I think the budgets, we are doing some things on the front end to ensure that they are properly being, submitted. If it comes in with no contingency, we're immediately putting a 10% on there, right? If someone can show that they've executed time and time again in this exact strategy, we could probably work down on that contingency a bit, but we really want to make sure that we have proper contingency put in there. And then we all know that I think the hardest thing inside of the value add space is GCs and management of the actual work. And so we do a GC, vetting and background and make sure that there's proper experience and and invoicing and billing and all that to make sure that they actually know how to properly carry through that project. Because we've seen so many times of someone just getting into bed with the wrong, GC type partner and not being able to execute on the vision that they clearly laid out for that GC.
So, how does experience in deal site and market conditions? I mean, we've already talked a little bit about the market conditions. How does that actually affect what a borrower can acquire in financing?
Mhm. So we have I'll break it down bridge and then kind of stabilized perm financing. So on the bridge side, we have a sweet spot of 5 to 50 units. Um, Typically a cap of up to $5 million on loan amount. We can push above that on an exception basis pretty systematically, so long as we have um, the right sponsor in place. But we do, from an experience standpoint, we want to know that that person has successfully gotten into and exited, whether it be refi to hold or to resell three multifamily properties, right? So at least three 5+ multifamily properties um, over the recent history. So that's going to be important to just the execution. I could say that has probably gotten a little stricter over the past few years. You go back 4 or 5 years, people were making money hand over fist, right, in the multifamily space without having a ton of experience, and there was so much debt in the marketplace. And I think we're seeing that come back a little bit as far as the institutional capital. I would say on this smaller balance side, really kind of re-enter more aggressively, but it's been a fluctuating market. So I think experience is certainly a very important thing at this point in time. And then on the DSCR, we just want to know that you've got one other multifamily. Again, that's up to 10 units on that DSCR product, but really aggressive rates, really strong loan features, 30-year fixed, 30-year amortization with, very minimal step down prepays and DSCR threshold requirements.
Well, let's go through the two different products.
Mhm.
Okay, so which do we want to tackle first, the DSCR or the bridge?
Let's go bridge first because kind of 1 to 2, right? Front
One to
end,
two.
take it. Yeah.
Okay, so walk us through a recent deal that one of your borrowers did, using the bridge product.
Mhm.
And let's actually start by defining what bridge is, just in case we have somebody super new here that doesn't
Sure.
understand that term.
Yep. Yeah, so recent deal, 80 LTC, so 80% loan to cost, right? And the way that typically breaks down is where I think we finance it was 70% of the purchase price and finance at 100% of the value add component. It's about $1 million acquisition and about 750 of construction. So all the units needed to be turned. I think it was if I remember correctly, like an 18-unit building, something along those lines. And it was yeah, up to 80 LTC, and essentially you're just tracking to the takeout, and so making sure that ultimately where the rents were prior to and where the rents are going, that those rents will support a 1.3 some odd DSCR, typically that a Fannie wants to see on the back end for the takeout. So yeah, it's the initial component disbursement for the purchase, and then you'll have this held back amount of money that we are dispersing over draws upon verification of completed work. So there's a combination of virtual inspections and physical inspections, depending on the scope and what's being done, to make sure that that work is being done. You're getting the invoices, and once that work has been confirmed, then that money goes back out for the reimbursement process. So when the work on the final unit is done, product is completely ready to go and ready for stabilization, that's when the final amount of the full disbursement money goes out the door. And with our product, it's non-Dutch, so you're only paying interest on the drawn funds. So that $1 million front end piece, that was you're paying interest on that from day one, but then that 750 holdback, as they draw money, their interest payment increases over time as they draw that money down.
Now, how are you looking at leverage and reserves with a particular investor here? So we talked about the 75%,
Mhm.
loan to cost. Are there any other terms here that we need to be looking at this type of loan?
So on a reserve basis, we typically want to see that a borrower has, obviously the amount for the down payment, all the necessary closing costs. You want to see that they have typically 10 to 20% of the budget readily available. And then ideally based if especially if there's no units and they're all turning over, there's no cash flow for them to rely on during a portion of that rehab process. You want to see that there's about 12 months reserves, right? Again, I think there may be some more competitive, I wouldn't even say competitive, looser potentially guidelines out there from various debt funds, but I just we believe in setting our borrowers up for success and making sure that they truly have enough to get themselves all the way through that project. We've seen a lot of horror stories over the past few years of people just getting sideways. I think not properly budgeting the cash needs of the business over that period of time. And then if someone does have the ability to, build in an interest reserve in these purchase transactions, bring some money to close to cover, maybe 6 months of interest, very strong credit enhancement that helps get that deal through and allows someone to, I think, set themselves up for success, not having to worry about kind of the month-to-month cash flow needs through the value add component of that project.
Now, you mentioned in this type of financing that one thing that gets investors in trouble is actually getting into a relationship with the wrong contractors. What is the role of the investor and what is the role of consistent capital when it comes to managing like the draw process and all those relationships? Is there red flags that we see up front?
So we can approve owner builders, right? So long as someone, meaning, an investor themselves, the person that's acquiring, taking on that project as the GC, if they've got plenty of experience to support it, right? We know those folks out in the marketplace that are great and they have their own crews and they manage through it in a really efficient way. I would say for the more passive people that don't have full teams built out around this, but they want to continue to invest within the multifamily space, that GC verification process is crucial, right? I think we see a lot of people because we have a large amount of our business is resi. We see a lot of our resi customers that, have built up a strong portfolio of, single family up to 4 units and maybe a little bit of small balance multifamily, and then decide that they want to elevate and kind of grow into that next phase of the business, which is taking on a 25-unit project or a 30-unit project. And I think in that transition, unfortunately, sometimes those GCs can't make that elevation from the more resi focused into the multifamily. So I think the scope of work is not fundamentally different. I think it's just the organization skills that are required of a GC to make that jump. And so sometimes those resi investors have to leave the resi GCs behind and elevate into a more commercial focused GC to be able to support that project and the needs.
When you hit a ceiling of achievement, you might need a new process or a new team member. That's what I'm
That's right.
hearing you say here.
Exactly right.
Okay, so anything else that we need to cover on the bridge debt?
Um, I mean, if there's any questions, in the comments, happy to answer. I think it's a very straightforward product as far as being able to support purchase and value add component and ultimately underwriting to the takeout and what that's going to be. So looking at kind of what the generally accepted prevailing rates are on the back end, underwriting the DSCR requirements using the pro forma you're going to provide to us is all super crucial. And so we're going to help to be there, not just as a lender, but like as a partner in that transaction, helping spot check your numbers, right? And again, not that we don't want to do deals, but we want to make sure that we're only doing deals that are supportive, ultimately to our customer, not going to put them in a sideways position. And then to us as a firm, of course. So we want to make sure that we are setting everyone up for success by fully vetting, diving into those numbers early and often.
Awesome. And guys, I know we have very specific questions regarding people's situations coming in. I promise you we will have plenty of time to get to those. I'm trying to stay high level here in the mechanics
Mhm.
process before we dive down into the specifics of
And
what.
happy to separately connect with anyone after this, talk through specific situations.
Yeah. So let's transition to the DSCR side.
Mhm.
Let's define what DSCR is, and then let's go through the process of how somebody, or of an example of a deal that you've done recently. The question that I actually have, if somebody takes out a bridge loan with you, can they use your DSCR product as well?
Absolutely. And it makes everything so much easier. But I will say, right, we do have limitations and caps on what we can support from a DSCR side. So DSCR means debt service coverage ratio, right? And this is a loan that is built for real estate investors buying properties for rental purposes. And a debt service coverage ratio is ultimately looking at what is the cash flow upside of this property and making sure that your cash flow is greater or equal to, in certain situations, we don't want to go that low, but greater than what your expenses are going to be on that property. And so the world of DSCR really was kind of built towards the residential investor, right? The residential kind of um, mortgage-backed security market is it's been a really hot product for a long time now. It still trades extremely well in the institutional capital markets, but it's been more focused on the 1 to 4 unit kind of residential type product. But residential groups like us that do have the majority of residential business, there's been this push of trying to expand the what the caps are on what you can lend on in a DSCR loan. So right now we can go up to 10 units on the stabilized kind of DSCR financing, and it's a very simple and easy product. We will go as low as like a 1-1 DSCR on that up to 10 units. We're up to 75% LTV on rate and term refis, 70% on cash out. Most of these situations do end up being refis. Having someone taking a C to a B class or B to a B plus kind of type strategy. Very rarely you see in kind of A class properties with this type of DSCR financing. But yeah, I mean it's really achievable DSCR standards. Experience, we just want to know you have one other multifamily property under management, and you've got some experience there. But it's very simple and easy to use, and it's something that we've kind of built our business on. In that 1 to 4 and that 5 to 10 is becoming a much larger part of our business going forward.
Now, I can imagine with the current rate or the past rate environment, and people are hitting maturities on some of their holds. Maybe they took
Mhm.
out an adjustable rate loan, that was maybe a 3-year term, 5-year term, 7-year term, and now it's maturing in 2025, 2026. What should an operator be looking at, if they're staring down a refi here in the next 3 to 6 months? What should be their first move? Is it sit and wait for interest rates to continue to come down by the Fed? Help us out.
I, I am never waiting around for Fed announcements to adjust anything in the mortgage market. So, I think we in the mortgage market, so much of what we do is based on the 10-year treasury, some certain situations, a 5-year. I think that that's a leading indicator for what's happening in the mortgage markets, but the Fed rate doesn't necessarily tie directly to that because mortgage markets really do bake in kind of investor sentiment earlier on, kind of what's expected as far as the announcement from the Fed. But I can speak to kind of the last two 25 basis point rate drops the Fed announced. We actually saw an increase to interest rates within our portfolios because it's already baked in. And I think the original expectation was maybe 50 basis points, and then it came as 25, and it actually worsened, but then it always settles out. So, I think we are in an interesting position because there are a lot of loans that are out there that were put in arms and were either written as 3 or 5 year balloons. We are only offering at this point in that 5 to 10 unit category 30-year fixed loans. So it is a 30-year loan. You can just set it and forget it, if you will. And I think there's a really viable opportunity to help people get out of a lot of more commercial type loans and into this more what has traditionally been a more residential product, DSCR loans with much easier loan features and terms to it. So I think there's some viability there for refinance to help someone out and get out of those situations with an impending, maturity or balloon on it and or adjustment on the ARM products and free up some liquidity to go do some more.
Awesome. And having held a portfolio of 40 rentals with an ARM adjustment on it, and then either liquidating or repositioning those into fixed rate debt, it was very much a relief. A little
That
expensive,
hurt.
but very
It
much a
hurts.
relief.
It
It hurt.
hurts. Yeah.
Well, it didn't hurt for me, but investors caught in this situation, I'm sure, they're thankful that there is a product out there.
Mhm.
I do want to start transitioning into some of the investor questions we have because we have
Sure.
several around kind of some unique situations.
Mhm.
One investor asked, about is seller financing possible? I would imagine that is, can you carry out a seller finance project?
Uh, we would have to be in first position, and I think there are certain situations we could allow for seller financing to be carried in second position behind us. But we do typically want to see that our sponsors, and whether or not they're syndicating that deal or putting up money themselves, have some skin in the game. So we wouldn't do it up to 100% CLTV, but I think there's opportunity to support and provide those situations where seller financing is gettable in second position behind us up to a certain CLTV.
Now, I think we've already answered this question, but I want to make sure we get it answered directly, especially for those investors that are looking at larger unit properties. If they do find and say like a loan assumption, but need a second, is consistent capital, do you have a product for that? Or is there a different solution?
Unfortunately not. So I mean we're going to be first position only. And I will say, the benefit of working inside of the commercial loan space is most of those loans, as long as it's negotiated and insured up front, can be assumable, sometimes with a fee. The loans that we do on the DSCR side, they are not assumable. I will say that and just put that out there. But and yeah, unfortunately, in the situation where someone's assuming a loan, we wouldn't be able to come in any sort of secondary position to support on financing.
And just a quick comment, what would be, should they go back to their regional bank? What should that type of investor look for?
When they are trying to assume a loan,
And possibly need to, get a second behind them.
I mean, it's a good question. I think from the lender's perspective, I can tell you that communication is key, right?
Mhm.
I think, try to do things back channeled. I would always involve your lender within those conversations, rather than try to, get something by and then have it come back to you. So I think I'm a big fan of transparency inside, outside of my business and making sure that those communication, protocols are in place in any of those situations. So I don't have a ton of insight on some of the back end of that, but communication is key.
Well, I could just see where the questions were going in the chat box. That was something that we were going to need to address. We have an investor that says, I'm planning building 27 dwellings, 8 building blocks, each of 4 units or less. I think I'm interpreting that statement right. Where does that fall for financing, commercial or residential?
The question would be how many different plots is that on? If it's all on, if each of those 4 units is on their own individual, like it has their own individual TMS number or APN, then those would fall in the world of residential. On the build side, and we would love to support that. We're doing that type of deal systematically. New construction, on whether it's spec build or build to rent, supporting with the ground up construction financing on a more residential product, and then taking that out into long-term financing on the back end.
And would that be utilizing the bridge product or is that a separate product?
It would be the residential bridge product, which actually has a little bit higher LTC caps, a little higher LTV, a little less. It's a little less stringent. And being that it would fall within the world of a more residential appraisal process, right? You're not underwriting as much to the ultimate cash flow because it's not the income approach. It's going to be based on sales comparables on the underwriting and appraisal side.
Another question, and I want to call this, let's play match the product. How about
Okay,
that? Do you
sure.
have a product that would be appropriate for a scrape and rebuild? Such as like maybe a single family 8 door unit.
Yeah, absolutely. So,
I don't know
uh,
if a single family 8 door unit, I don't know which one we're doing there, but yeah.
So single family, we'll start there. Yes, absolutely. We are doing that. That's probably about 50% of our business, honestly, of ground up construction financing, providing that ability for someone to do either kind of scattered lot infill opportunity of scraping a building or buying a vacant land and building ground up, or more horizontal type development, small community development. We can do that as well. And then when it comes to 8 units, once you start to push above the 4 units, so 5+ into the multifamily space, then it does fall within the world of what we're talking about on Bridge, multifamily value add, which we're primarily focused on value add, taking something not so nice and making it nicer, as opposed to just taking something that doesn't exist to creating something. But we are in one-off situations looking at those opportunities, especially for really experienced sponsors. We could take a look at some ground up opportunities, but I will say that that'll probably capped at maybe up to about 20 units total.
And just for clarity, it's scrape the existing single family and build an 8-door complex on the
Oh,
double.
okay. So that would fall within the multifamily world, but there is an opportunity at that. We can certainly take a look at it.
I have a question,
Mhm.
hashtag asking for a friend. Certain municipalities are allowing, ADUs to be built in order to increase density. Is that something that you would have a product for an investor to do?
Sure. Yeah. I mean, I think it depends on what the property is, right? If it's a single family or 1 to 4 unit and they want to add an ADU in the back, again, as long as the municipality and the zoning and permitting process allows for it, we are doing that right now for folks where we're providing, cash out refinances on the property, and supporting with the construction on the ADU component. While the ADU is nice to have. Just as a note, it won't qualify towards GLA, so it won't be considered gross living area, but it is absolutely an amenity that gets added into the value assessment of the property. And we can utilize ADU rent so long as it is permitted and zoned accordingly towards the DSCR calculation.
And is this on primary or only on investor property?
Only investment. So we will never, and I have never lent on a primary residence, only investment properties, no second homes either.
Noted. All
Yep.
right.
Thank you for that.
Yeah. What options do you offer to extend the bridge debt if the property takes longer to stabilize?
Yeah, I mean, hey, it's a portfolio product that we're offering, and so we understand that things happen, things change, right? And while you go in with even the best baked plan and making sure everything is correct in the pro formas, things happen, whether it be, city issues, utility issues, value add component issues with GCs. There are extensions available. Those are easy to work through as long as you are communicating actively through that process. Do not get to the end of your loan. Do not let it mature and then the next day ask for an extension. You should be asking for that extension or anticipating you might need it 90, 60, 30 days out. You have to be communicating on the front end, or else that's going to be a whole lot harder to work through.
Hmm. Is there a limit for cash in hand for payments on services trades over which the payments are made directly to the subs?
Is there a limit? Ultimately, for our draw process, we prefer to pay the sponsor and then they make payment to their GCs and subs. So there is nothing nefarious and GC can't just walk away with money. And it frankly relieves us of a little liability as well. There's no necessarily cap to that. We're going to be reimbursing funds based off of completed work, though. So there's not a cap. If you've gone out and done $1 million worth of work, and we can verify that, you get that wire for $1 million.
All right, and I think we have one more question on the bridge debt. This is your opportunity. If you have questions, dump them in the Q&A box. We would love to address them. And then we'll wrap up with a couple market questions, tapping into your knowledge and expertise with. What kinds of rates are we looking at for the bridge debt product, and are there prepayment penalties?
It's a great question. So rates right now, I can tell you are probably in like the 10, 11 range on that. And again, it's non-Dutch, so you're only paying interest on initial disbursement funds to start. And then as you draw money over time, that interest payment will increase. Um, no prepayment penalties on the bridge debt. That wouldn't make money. We want to incentivize and encourage our sponsors and investors to work through projects as quickly as they can, right? So on the DSCR side, there are prepayment penalties, kind of stock rate sheet. We can, get really creative with the way that we structure that. We can do anything from a 5-year 5% prepay that'll give you the lowest rate possible. We could get to a 1 year 5% or a 1 year 1% or no prepay, which will be the most expensive as far as the prepay options go. So longer the prepay, the lower the rate, lower prepay, higher the rate. But at the end of the day, the adjustments are not massive. And so I think we can get creative and flexible in the way we structure a deal to fit your investment horizon and make sure that it makes sense based off of what you're doing for that project.
Hmm. All right, we do have a couple questions here. One regarding the market. Would you consider any deals in the Northeast?
Absolutely. Yeah, we actually are just closing on a, Pawtucket, Rhode Island, multifamily deal this week. I've got some other deals in the pipeline that are in and around that area, Massachusetts and Connecticut, that we love. I'm from Connecticut originally. I know the market. I love it. I think there's great opportunity up there. Um, so yeah, Northeast all the way through Mid-Atlantic, Southeast, Midwest. I said again, we're going out to Colorado. The only state we're not lending in that's essentially Colorado and East is Minnesota. We are working on getting licensed to operate as a lender outside in California and Arizona, but not there currently.
Mm. So I had a couple of people ask about Southern California. It sounds like that's off the table for the moment.
For the moment. But if anyone, and I'm always happy to be a resource for anyone too, I can point you in the right direction of folks that offer something similar for the period of time until we are ready to go, and then you come back to us.
Well, I think that's a great segue. If somebody wants to learn more, how can they get in touch with you?
So you can go on our website, see some information on us, our company, who we are at www.consistentcapital.com. You are welcome to reach out to me directly. My email is whit, WHIT, at consistentcapital.com. And yeah, look forward to chatting with anyone. Again, even if it's something that we are not able to support with, I'm always happy to connect. I'm a real estate nerd, just like you, Whitney. Like we all love this stuff, and I love talking about deals, even if it's not deals that we can lend on.
It's always fun when we're in the same room.
I know.
That's what
It
we're
gets
like,
a
oh,
little
gather
confusing at
around.
times. Yeah.
Yeah. Well, we do have another question about the market, and I have a wrap-up question for us. An investor asked, being in the Charleston area, can you speak to the Greenville MSA multifamily market?
It's interesting. I think there's been a lot of investment within Greenville over the past few years. I think it's been a really, really hot market. We know there's going to be a lot of deliveries coming up and they're still being worked on, but I still see so much strong economic indicators for what Greenville offers. I think it's a great place for employers. I think there's a lot of good, just kind of economic direction with that MSA. So I think we're committed to it. We really love that market on both the resi and small balance multifamily side. Deals are hard though because there has been so much interest and appetite for that market. But at the end of the day, right, I think a deal is only as good as the debt you can put on it. So hopefully you can align yourself with someone like us or someone else who's able to support you with those investment endeavors.
Awesome. Well, Whit, thank you so much for joining us
Thank
today,
you.
sharing your knowledge and expertise with us. As we wrap, we talked about a lot of different ways in order to make the deal work. Is there anything that an investor should be watching out for that, would, I guess put them in a better position for financial success?
Yeah, I participated in an MFN event a while back, and I think just as a sponsor, as a borrower, right, that's trying to align yourself with a good debt or even equity type partner in any sort of deal, just organization is so critical, right? And I think you can very easily tell someone who is likely going to put themselves in a tough position based off of the way that they present their information, right? Make sure your numbers are locked in and they are certain, right? As certain as they can be. Make sure that you've got all of your stuff organized and ready to go, all of your entity docs, your GC docs, your budget, your purchase sale agreements. You have everything ready to go within a certain, Dropbox or Google Drive. Have that in a position that you can share that with the folks in a very clean and easy way. The ones that are piecemealed all over the place and are messy and pro forma numbers are not calculating correctly within the Excel. It's a very clear indicator of just organization and how that will likely be a tougher project. So I think organization is key in aligning yourself with debt and equity partners out in the marketplace.
Wise words, Whit. Well, thank you again for joining us today. For those of you who are looking to reach out, can you tell us one more time how to do so?
Whit whit@consistentcapital.com. You can hit me by email, go to our website, consistentcapital.com, and learn some more about us. Follow us on socials, at Consistent Capital on Instagram. We always have some good and exciting content in there, and LinkedIn, all the above. So, yeah, really look forward to connecting with any of you. And thank you so much for having me, Whitney, for the great questions. And thank you, everyone in the chat, for all the great questions as well.
Awesome. Well, until next month, you will be back with me, and we're going to
Love
be
to.
talking about some lead generation strategies. So stay tuned. We'll get that email out to everybody. Again, Whit, thank you so much. Have a great day.
Thanks so much, guys.